Hello everyone, today we're going to cover Chapter 13, Tax Credits and Payment Procedures. So let me start by sharing my screen, and here we have it. We are going to start, as always, with covering the big picture scenario. We need to understand what's going on to kind of know where we're going in the chapter. So Tom and Jennifer, they are a couple and they have two kids, Laura and Sam. They're going to college. Laura's tuition and required fees in 2025 are $14,000. Laura has a partial scholarship of $6,500, and the couple paid the balance of her tuition, $7,500 plus room and board of $8,500. The couple also paid $8,100 for Sam's tuition plus $7,200 for his room and board. And both students qualified as Tom and Jennifer's dependent. Okay. So we also have another important information. The couple's adjusted gross income is $158,000. And they came to you because they want to know if there are any tax credits that can help them reduce their tax liability. So they are particularly thinking about education credits. Okay, so now you need to remember that we have different rules, and the education credits are the last part in the tax return. So to remember this, let's start with the form 1040. I hope this is familiar to you. We generally start with the income. What is income? And then we apply the exclusions. Actually, we just report the exclusions, but we know that there are certain income that for policy reasons will not be included as taxable income, okay? And then after that, we end up with our gross income, as you can see here. And then we have the famous deductions for adjusted gross income or above the line deduction. Finally, we're going to end up with our AGI, adjusted gross income. And then we have another opportunity to apply more deductions. And here we have options. We can apply the standard deduction or list of deductions that we just covered last class, the itemized deductions, okay? So we don't have dependency exemptions anymore, so please disregard that. But after we apply all these deductions, then we end up with our taxable income. And that is the amount that we're going to use to apply the tax rates based on their filing statuses and based on the amount of income that this couple has in any given tax year. Okay? So after that, we are going to have an additional benefit. This is great because we're going to have the possibility to reduce our taxable income. After we have calculated the amount of our taxes, we can apply these credits to reduce our taxes and sometimes get a refund because we have different type of tax credits. Some tax credits that will just reduce our taxable income, and another type of credits that will allow us to get a check at the end of the presentation of your tax return. So that is the general picture. Here I have included a chart, as always, a summary that can show you more or less where we are. Okay, this is the same as this, but with more relevant information. So we start with the total income, our lines 1 through 8 in our form 1040. We know that we have to include there our wages, interest, dividends, retirement income, social security income, capital gains, all our income, business income. And then we are going to apply, again, certain exclusions. And just as a refresher, you have the life insurance that benefits, they are excluded, gifts and inheritances, they are not taxable income, they are excluded. The particular code provision is here, 102. Muni bonds, interest, workers' compensation payments, disaster relief payments, and more. So that's just a summary. Then you have the opportunity to subtract or apply certain deductions. Those are the famous above the line deductions. And we're talking about the educator expenses, just up to $300, self-employed contributions, Okay, contributions, retirement contributions, half of your self-employment tax also is an above the line deduction. HSA contributions, student loans, interest that you have paid, moving expenses, alimony pay, but that is just for tax years before 29. Kind of disregard that, but this is giving you a general idea of what's going on in your tax return. And hopefully, once you see this, you can remember everything that we have covered so far. Okay, and after you apply these deductions, you know that you end up with your adjusted gross income. So great. Now you kind of are remembering what's going on. And after we find out what is our AGI, we apply the standard deduction or an itemized deduction. And just as a refresher, standard deduction depends on your filing status. Okay, last class I was kind of asking you what are the different type of filing statuses that we have. And some of you remember single, head of household, filing jointly, married filing separately. Okay, so if these are your filing statuses, then these are the amounts of standard deductions that you can claim. Now, when we are here in this line 12, we have the opportunity to choose this amount or maybe itemized deductions based on what is the higher amount, what is better for me as a taxpayer. And also something that you need to remember is that there's a difference. The standard deduction is a set amount. No questions asked about what is the amount of the deduction that you actually incurred in. It doesn't require substantiation. You don't need to keep receipts or prove that you really incur in these expenses. I mean, yeah, because the itemized deduction, they are allowing you to claim deductions for certain expenses, personal expenses. Okay. If we were talking about, again, as a reminder, about any business expenses, you already know that you are fully allowed to claim any business expenses, meaning you have a business and you're incurring in reasonable expenses and ordinary expenses to produce certain profits in your company, you are going to be allowed to get those deductions. But whenever we're talking about itemized deductions, we're talking about personal expenses. So which are those expenses? Medical expenses above the floor, and the floor is 7.5% of the adjusted gross income, meaning my expenses that exceed 7.5% of my adjusted gross income will qualify as an itemized deduction. State and local taxes, but there is a cap, $40,000. Okay. Then my home mortgage interest on properties that are, that have a value less than $750,000. Charitable gifts, casualty losses. So there are different rules that we have covered before in detail. They can be complex, but I just wanted to give you a summary so you could kind of have an idea of what is going on. Okay, so we have covered all this. And then obviously one important deduction is the qualified business income deduction. It could be up to 20%, but there are many rules that apply here. There are certain limitations, and if you are conducting a specified service, trade, or business, you have more limitations. I'm not going to go into detail here because we have covered this before. I just want you to remember that this is the framework of what we have covered so far. And we're kind of at the end of the class, the chapters. We are finalizing the review of Form 1040, so it's important that you put everything in context. Then after that, after I have applied all my deductions, standard deductions, and if I am conducting a business, the QBI deduction, then I will end up with my taxable income. At this point, I will apply my tax rates. And in prior classes, I share different tables because we have different percentages depending on your filing status. We always look at the filing statuses to calculate what is your taxable amount. And after that, we have the income taxes, and your income taxes can be not only the tax on the wages, on the income that you have earned. You might be subject to additional tax like the alternative minimum tax. If you are a taxpayer that makes a lot of money, we are gonna make an additional calculation. Actually, that was chapter 12. We skipped chapter 12 because we couldn't cover the whole book, but I'm going to do a summary of what is the alternative minimum tax in a second, but that is something that you need to keep in mind. Okay, so after we have calculated the amount of our income, we're going to apply the tax rates, but we're going to have additional taxes that we may need to pay, like the self-employment tax. So first, we're going to pay taxes on the income that we have earned, and also we are going to pay an additional tax because we were self-employed. Then we have also the net investment income tax, which is 3.8% of the investment income. The additional Medicare tax, we're going to cover that if we are dealing with high earners. And if you have received any advanced premium tax credit, we're going to pay that. We're going to return that money to the IRS, and so on and so forth. So we're going to get into more details here, but this is a summary that, like I said, I wanted to share with you. Now, in the world of credits, this is the chapter that we are going to cover today. We have multiple tax credits. We have the foreign tax credit that prevents double taxation whenever we are making money outside of the US and we're paying taxes in those territories. We have the possibility to get a foreign tax credit. Then we have the child and dependent care tax credit, education credits, the American Opportunity Tax Credit, the lifetime learning credit. Then we have savers credit if we are making contributions to our retirement accounts, residential clean energy, adoptions, general business credits, and more. So that is what we're going to cover today. So hopefully now you have a better idea. Like I said, this is the general framework, but here are the details. Okay, so now let's get into what are tax credits. And we're going to start with tax policy considerations. Why do we have these tax credits? Why don't we just have deductions? There is one main difference with deductions and tax credits. Tax credits are certain amounts that will not generally depend on the tax rate that you're going to pay. Generally, what we are trying to do with tax credits is first, we want to encourage certain behavior on the taxpayers, and also we want the impact on the taxpayers to be the same. Whenever we're dealing with a tax credit, this is not affected by the taxpayer's tax rate. So here we have example 4, assume that Congress wants to encourage a certain type of activity. One way to accomplish this objective is to allow a tax credit of 25% for any expenses paid related to the activity. Another way is to allow an itemized deduction for the same expenses. Abby's tax rate is 12%. Bill's tax rate is 35%, and they both itemize their deductions. It does not incur enough qualifying expenses to itemize deductions. The following tax benefits are available to each taxpayer for a $1,000 expense related to the activity. Okay, so we have 3 taxpayers, Abby, Bill, and Carmen. And there is two possibilities that they have. They could either use this expense and claim a deduction or get a tax credit. If they want to get a tax credit, all of them are going to get the same amount of credit. It's just 25% of the expenses. Okay, so if they incur $1,000 expense, then Carmen will get $250 as a credit, Bill $250, and Abby $250 in this tax credit. But now if we look at the deduction, if Carmen were to claim a deduction, she's not going to see any tax benefit, because what is she's going to get? She's going to get a standard deduction, okay? She doesn't have enough money to qualify for an itemized deduction, and we kind of covered this at the beginning. If we have more in standard deductions, then we're not going to claim the itemized deduction. So as you can see here, Carmen is not going to get this. Okay, if they had a possibility to claim a deduction. Another thing that you need to remember is that they cannot claim both a credit and a deduction. They need to choose one. But in this case, we just want to analyze what is it that the lawmakers or Congress should do. Should they just say, hey, this is a tax credit or this is a deduction? And here is the policy reasoning. If they want all taxpayers to get the benefit in the same way, they will make it a tax credit. But let's see the difference. If we are talking about for any given $1,000 that Abby is going to claim as income, if she is allowed a deduction, then what is her tax savings or the tax benefit? Well, it's worth $120, right? Because if she was paying taxes for $1,000 and her tax rate is 12%, that is the amount of taxes that she will have paid. Okay. And the same with Bill. His tax rate is 35%. So if we take 1,000 from that, what he is not paying is $350 because his tax rate is 35%. Okay, so the benefit is a tax. If the tax deduction is allowed, for Abby is 120, for Bill is 50, and for Carmen is 0. If you treat this as a deduction. Okay, so the tax credit can provide an equal incentive to all taxpayers for the same action, regardless of their income. So that is why the lawmakers are choosing to make this a tax credit as opposed to a deduction. Overview and priority of credits. So we have two main categories, refundable versus non-refundable credits. A refundable credit is paid to the taxpayer even if the amount of the credit exceeds the taxpayer's tax liability. What does that mean? If you qualified for an education credit, for example, let's say you are going to school, you are supporting yourself, and you are paying for your tuition, and you are allowed to get the American Opportunity Education Credit. And that is in the amount of $2,500. But in that year, you work very little. I mean, you just had a part-time and you really don't have any taxable amount because your standard deduction is high, more than $13,000. So you end up with no tax liability because all your taxable income was excluded because we applied the standard deduction in your situation. So what is happening? What's going to happen with the $2,500? You can see there that the amount of the credit exceeds your tax liability. And if that is the case, the IRS will send you a check for $2,500. That's what it means. But if this was a non-refundable credit, like the lifetime learning credit, which is an education credit, and probably this taxpayer didn't qualify because, I don't know, she wasn't a full-time student or she was just taking a couple of courses and the amount of the credit is just 20% of her expenses up to $2,000. And she had $2,000 in this non-refundable credit, but she had no tax liability. Since this is a non-refundable credit, unfortunately, she's not going to see any tax benefits. Okay, so in her case, in the world of education credits, you just lose that tax benefit if you do not have any taxable income for any given tax year, which is not going to be the case if we are talking about business credits. There are certain business credits that you can carry forward, okay? But generally, that is not the case. So refundable versus non-refundable, I will choose refundable credits all day, every day, because that will give me the opportunity to get a check from the IRS as opposed to the non-refundable credit. Perfect. So here's some examples. Refundable credits, we have taxes withheld on wages, child tax credits, earned income credit, the Affordable Care Act premium tax credit. Those are refundable credits. And the non-refundable credits, generally we have the general business credits. We have a long list of credits here. We have the tax credit for rehabilitation expenditures, work opportunity tax credit, research activities credit, low-income housing credit, disabled access credit, credit for small employer pension plan, startup costs, credit for employer-provided child care, for employer-provided family and medical leave. So generally those are the business credits. But in the general business credit, we have different type of credits. Now, we have other non-refundable credits like the credit for elderly and disabled, the foreign tax credit, the adoption expenses credit, dependent tax credit, education tax credits, but not all of education tax credits. Actually, the American Opportunity Credit is it's partially refundable and partially non-refundable, but we're going to cover that in a second. Energy credits as well. Okay, so here let's start with a big one, the general business credits. This is a type of credit that includes a number of other credits, and each of them are going to be computed separately, but we're going to apply a limitation. So you are going to be allowed to get this credit, but unfortunately there's a limitation that you have to apply. So we have to follow different steps here whenever we want to calculate the general business credit. And we have seen that there are different type of credits that will be included in the general. So whenever we're dealing with the general business credits, we're talking about that group of credits. Okay, so the general business credit is the sum of all individual credits that I just showed you minus a limitation based on the tax liability. So how do we calculate this? This is limited to the net income tax reduced by the greater of the tentative minimum tax or 25% of the net regular tax liability that exceeds $25,000. What is all that? To be able to understand this, first we need to understand what is the tentative minimum tax. But generally, the general business credit is equal to the net income tax, okay? So your net income tax minus the greater of either the tentative minimum tax or 25% of your net regular tax liability minus $25,000. If you're not able to use all the credit in one given year, you can carry back the unused credit 1 year and then forward any unused general business credit 20 years. Okay, so first we have a general business credit. I mean, let's say we have a business that has qualified for all these credits: tax credits for rehabilitation expenditure, work opportunity, research, low-income housing, disabled access, had provided compensation for workers that had to take a leave of absence because of a medical condition. So this taxpayer has this huge amount of general business credit that now they cannot claim in one single tax year because we have certain limitations. That is it. That is what we are reviewing here. So this taxpayer cannot claim the full amount of the general business credit. So what's going to happen? This is the formula. It's a little bit complex directly from the Internal Revenue Code, but we're going to understand this little by little. So generally, the general business credit is equal to the net income tax minus the highest amount between the tentative minimum tax or 25% of the net regular tax liability minus $25,000. So now let's review what is a tentative minimum tax. And this was chapter 12, a chapter that we skipped because it is impossible to cover the whole book. The book is so big. So the tentative minimum tax. The tentative minimum tax, or TMT, is part of the alternative minimum tax system. So it ensures that taxpayers with a lot of deductions still pay a minimum amount of tax. So the alternative minimum tax is the excess, if any, of one, the tentative minimum tax over the regular tax for the tax year. Okay, so let's calculate this. The alternative minimum taxable income first. It's just the regular taxable income, but we are going to add back certain deductions. First, you're going to grab your regular taxable income and we're going to put back state and local taxes, some depreciation of personal and real property, certain research and experimental expenditures, because we had already claimed this as a deduction. Remember, whenever we're looking at your taxable income, we had already applied certain deductions. But whenever we're looking at the alternative minimum tax, we want to bring that back. We're going to add it back. So this is kind of a separate calculation that we're doing, a separate book to determine if there is something else that I would have to pay other than my taxes on my taxable income. Yes, the answer may be yes or no, depending on how much deductions you have claimed, okay? Okay, so then we start with your regular taxable income. We are bringing back all those deductions that I just mentioned, and then we are going to subtract an alternative minimum tax exemption. This is an amount that is adjusted for inflation, so you need to get these numbers for every tax year. So for tax year 2025, this exemption, AMT exemption amount is $137,000 for married filing jointly taxpayers. For single taxpayers, the amount is $88,100. For married filing separately, the amount is $68,500. So again, we are going to start with your regular taxable income, and we're going to subtract this exemption amount depending on your tax filing status. Of course, if you are making a lot of money, this exemption is going to be reduced. That's why here you have a line that says the exemption phases out at 27 per dollar of the alternative minimum taxable income above. For married filing joint taxpayers, $1,252,700. You see, you have to be making a lot of money to lose the alternative minimum tax exemption. If you are single, you have to be making more than $626,000 to lose this exemption. So let's just remember the general rule. We're trying to calculate this tentative minimum tax because we want to tax you. We don't want to have taxpayers with a lot of deductions and not paying a certain amount of taxes. Okay, so we start with the regular taxable income. We're going to subtract the alternative minimum tax exemption amount based on your filing status, and then we're going to apply certain tax rates. The first $239,100, we're going to apply the tax rate of 26%. Then an amount that exceeds that, you're going to apply 28%. Now, you're going to subtract the alternative minimum tax foreign tax credit, which is an amount based on your foreign tax credit. For now, we are going to just assume that this taxpayer only works in the US. So that will give you the tentative minimum tax. Now, if the tentative minimum tax is more than your regular tax, the excess will be the famous alternative minimum. But we wanted to know how much of the general business credit I can claim in any given tax year. That was the question. How much of the general business credit can I claim in any given tax year? And to do that, to arrive to this calculation, we wanted to know what was the tentative minimum tax. Okay, now that we know what is a tentative minimum tax, we can proceed with the calculation. And don't worry, you're not going to be tested on the calculation of the tentative minimum tax because we skipped that chapter. You are going to receive the calculation, like in this example. Okay, example 7, they are already telling you what is the tentative minimum tax. So let's go over the this fact pattern. Alessia's general business credit for the current year is $70,000. They're making it very easy for you. They're not telling you which business credits they are talking about. They're just telling you, hey, the general business credit for the year is $70,000. Now, her net income tax is $150,000. And the tentative minimum tax is $130,000. And the net regular tax liability then is, so here they are telling you that the tentative minimum tax is less than the regular tax. So there's no excess, there's no an additional tax that she needs to pay. But still, the tentative minimum tax calculation is relevant because that is something that you need to keep in mind to calculate what is the amount that you're going to be able to claim as the general business credit. So let's go again. Alessia's general business credit for the current year, $70,000. Her net income tax is $150K. Tentative minimum tax is $130. So at the end of the day, how much is paying in taxes? $150. Now, she has no other tax credits. I hope that you can see that the net income tax is the taxable amount that she potentially had to pay before we apply this credit. Now, these tax need to be considered whenever we're trying to understand what is the amount of general business credit that we are allowed to get for the tax year. So we start with one stand, the greater of the tentative minimum tax, or 25% of the net income tax minus 25,000. And if we calculate this, that would give us $31,250. So what is the greater amount? The greater amount is $130,000. Okay, what would be my amount of general business credit allowed for the tax year? Well, it would be 150 minus 130. So that is the general business tax credit that Alessia will be able to claim in this tax year. So Alessia has $50,000 in general business credit that she will have to carry back or carry forward. She can carry back this for 1 year or carry forward for 20 years, okay? Because in this tax year, she will be able to claim only $20,000. So now let's start learning about these specific business-related tax credits, all these tax credits. Now we're going to cover the tax credit for rehabilitation expenditures. This credit is provided because we want to encourage business owners to stay in the location that they are and not move to another better location, newer location. We want to encourage them to spend money on repairing or preserving these historic structures. The value of the credit is 20% of qualified rehabilitation expenditures related to a certified historic structure. And this type of structure can be either residential or non-residential as long as it is certified, meaning it is registered. They have followed the procedure to have this property certified as historic structure. Now, this 20% of the credit, they will be able to claim it over 5 years. Starting with a year, the rehabilitated building is placed in service. Now, the credit will affect the basis. If you get this credit, you will have to reduce your basis by the full rehabilitation credit allowed. To qualify for the credit, there has to be a substantial rehabilitation over a period of 2 years. Okay, that is the requirement. How do I know that this is substantial? Well, your expenses need to exceed the greater of $5,000 or the adjusted basis of the property before the rehabilitation expenditures. Okay, so if your expenses exceed the greater of $5,000, or the adjusted basis of the property before you incur all these expenses, then we were going to consider this as a substantial rehabilitation. So examples of these certified historic structures, they could be individually listed on the National Register of Historic Places. For example, a historic courthouse built in 1890 and listed on the National Register, a Victorian era home officially recognized as a historic landmark, or maybe structures that are located in a registered historic district. For example, a 1920s commercial building in a downtown historic district that retains its original structure and architectural features. A brick warehouse in a designated industrial historic district that contributes to the district's historic character. So, as you can see, this requires certain registration. Now, the qualified rehabilitation expenditures do not include the cost of acquiring a building, the cost of facilities related to a building, such as a parking lot, the cost of enlarging an existing building. We are trying to give you a tax credit because you are incurring in substantial expenses in rehabilitating these structures. Now, another type of general business credit is the work opportunity tax credit. This applies to the first 12 months of wages paid to individuals falling within a target group. What is this target group? Who are these individuals that are within or fall within the target group? In this group, we have qualified veterans, long-term unemployed individuals, recipients of temporary assistance for needy families, supplemental nutrition assistance program recipients, ex-felons, vocational rehabilitation referrals. So if you are providing jobs to these particular individuals, then you can qualify for this credit, work opportunity tax credits, for the compensations that you're making to these individuals for the first 12 months of wages. Okay, it's not forever, just 12 months of wages. Now, the credit has a limitation. What is the limitation? You will be limited to either 40% of the first $6,000 or 25% of the first $6,000. So if you are employing an individual that belongs to a target group and that has worked at least 400 hours, then you will qualify for 40% of $6,000. But if you are working with an individual that belongs to this target group but doesn't meet the 400 hours requirement, then you can claim only 25% of the first $6,000 of wages that you have paid to this employee. Okay. Here we have a detail that is very important. It says that the deduction for wages is reduced by the credit amount. And this is something that you should remember. Like if you're conducting a business and you're paying your employees, that will give you automatically an above the line deduction, right? You're going to reduce your taxable income, but this amount immediately. What we're telling you here is that you cannot get a double benefit for the same amount. So the scenario is this. You have an employee, you have paid this employee for the first 12 months of work, $10,000. And we want to know what is the work opportunity tax credit. Well, the work opportunity tax credit will be 40% of the first $6,000. And that is $2,400. Great, I'm gonna get a tax credit of $2,400. Now, what would be the amount of your deduction? Because you know that any compensation that you're giving to an employee is giving you a deduction, right? Here, what we're trying to emphasize is that the deduction for wages will be reduced by this credit amount. So whenever I'm calculating my general above the line deduction, I will reduce $2,500 to my $10,000. So my deduction for compensation for services to this particular employee will be $7,600. 100. And then whenever I'm including my credit, my business credit, in this particular category of the work opportunity tax credit, I will only include 2,400. So hopefully you can see the difference between a tax credit and then a deduction for whatever amount you're paying to your employee. Again, what you have to remember is your deduction for wages will be reduced by the credit amount. Okay, so here we have an example. Example 10. In January 2025, Green Company hires 4 individuals who are certified to be members of a qualifying targeted group. Each employee works 800 hours and is paid wages of 8,000 during that year. I mean, this is very easy. All of them belong to this targeted group, and all of them have worked more than 400 hours. So my credit would be 40% of the first 6,000, right? $9,600. That is the amount of the work opportunity credit, because we have 2,400 times 4, so 9,600 is the amount of the work opportunity credit. Now, if the tax credit is taken, Green must reduce its deduction for wages paid by 9,600. No credit is available for wages paid to these employees after their first year. Yes, we know that because we said that you are only allowed to get a credit for the first 12 months. Here it is. Applies to the first 12 months of wages paid to individuals. Now, another business-related credit is the research activities credit. We want to encourage businesses to invest money, to spend money on research and experimentation. And where? Well, in the US. So you're going to see, or we're going to share more information about this particular credit, but we want to encourage businesses to spend money on research and experimentation. This is the famous research and development credit, R&D. So there are 3 parts that you need to keep in mind. We have the incremental research activities credit, the basic research credit, and the energy research credit. Okay, so this research is very important, and we need to know first the research credit is not allowed for certain things. It's not allowed for research conducted once commercial production begins, because at that point, all the research has already been completed. It's not for that. It's not for surveys and studies related to market research, testing, or routine data collection. No, it's not for that. It's not for research conducted outside of the US, Puerto Rico, or US territories or possessions. It's not for research in the social sciences, art, or humanities. It's not. So we said that we have 3 parts in this research, right? The incremental research activities credit. So we have our credit amount that is 20% times the qualified expenditure minus a base amount. So what is the credit? 20% of the qualified expenditures minus the base amount. The base amount is something that you are going to receive. I mean, because we're not going to calculate this. It is kind of complicated, depends on certain expenditures that you have incurred in the if not, you are a startup and there is a formula, a percentage that we need to apply. So you're going to be given the base amount. Okay, but generally, whenever you are trying to calculate these expenditures, we want to see what is the increment research, how much you are spending to expand your research activities, and you're going to get a credit for that increment. So that's why we need to know what are your qualified expenses, and we need to know what was your base amount. In any given tax year, we need to have this base amount to compare it with your qualified expenditures. Only then we're going to be able to see what is the increment. And on that increment, we're going to apply a 20%, and that will be the credit amount. So the base amount is determined using historical levels of research activity. We need to see your history. And then the purpose of using a historic base is to ensure that the credit rewards taxpayers who increase their research over the base level. This is the formula that you don't have to remember, but it's there. The base amount is equal to the fixed base percentage times the average annual gross receipts for the preceding 4 years. And the fixed base percentage will depend on when you started these research activities. Expenditures qualify fully if research is done in-house. What does that mean? We are going to just qualify certain expenditures if you are outsourcing the research activities, if you're hiring somebody else to conduct the research, okay? And if that is the case, the value of your qualified expenditure is going to be limited to just 65%. Here's an example, example 12. J. Vieira incurs the following research expenditures. In-house wages, supplies of $50,000. Payment to Cutting Edge Scientific, a contractor, $30,000. So here we're trying to apply the 65% limitation. So J. Vieira's qualified research expenditures are $50,000 because that's the full amount of the in-house research expenditures plus 65 of the 30,000. So that gives you 69,500. The contractor payment is multiplied by 65% because only a portion of the contract research cost qualifies under IRS rules. And now example 13 says, assuming that the base amount of J. Vieira's qualified expenditures was $10,000, the incremental research activity credit is $11,900. How so? Well, it will be 20% of the increment. The increment is $59,500. 20% of that is $11,900. So that will be your credit, research activities credit. Actually, the incremental research activities credit, because we know that we have multiple credits in this area, 3 actually. There's another method to calculate this incremental research activity credit. The simplified method equals to 14% of the qualified research expenses for the year in excess of 50% of the average qualified research expenses for the prior 3 years. So if you want to just apply the simplified method and not look at the base amount, sometimes the base amount, like I said, will give you some problems because if you are dealing with a business, an actual business, you will have to see the historic expenditure of this company. And sometimes that will be a little bit hard to find out what is my base amount. The credit would be equal to 14% of the qualified research expenses for the year in excess of 50% of the average qualified research expenses for the prior 3-year period. Now, to prevent taxpayers from receiving multiple tax benefits from the same expenditure, any taxpayer that is claiming a research credit must make one of the following adjustments, okay? Reduce their R&D deduction by the amount of the credit, or elect to claim a reduced research activities credit. Of the basic research credit, that is an additional 20% credit that is allowed on basic research payments made in excess of a base amount. Okay, so basic research is any original investigation for the advancement of scientific knowledge, not having a specific commercial objective. Any investigation for the advancement of scientific knowledge. That's it. That is the basic research credit. The basic research credit calculation is based on the expenses in excess of an specially defined base amount. So the base amount here is kind of crazy. It's specially defined, and you're not going to be given the task to calculate the base amount. Just keep in mind that there's a basic amount. So the portion of the basic research energy research credit. Okay, another type of research activities credit is the energy research credit. This type of credit encourages taxpayers to support tax-exempt organizations conducting energy research. So if you are contracting these or getting services of these particular organizations, then you can get a 20% credit for the payments made to these organizations that are conducting this particular research. Now, let's talk about a different type of credit, low-income housing credit. The low-income housing credit exists to encourage the development of affordable housing for low-income individuals. What is the amount of the credit? Qualified basis of the project times a credit rate. So the qualified basis will be a proportion of the basis in the entire project allocable to use by low-income tenants. So if my whole building will be used by low-income tenants, then that will be the qualified basis. But if only, half of these establishments will be dedicated for low-income tenants, then my qualified basis will be just half of all the expenses that I'm incurring in developing these housings. Okay, and what is the credit? This is a type of credit that is designed to encourage developers to develop more affordable housing for low-income individuals. So if they do that, they're going to get a particular credit. What is this annual credit? Well, it's the qualified basis of the project times a credit rate. This credit rate is something that the IRS publishes annually, and it could be 9%, 4%, depending on the type of property, and is designed in a way that this credit can be taken over 10 years, and it will be roughly 70% of the value of the qualified basis of a building. So that is something important to remember. The IRS publishes the rate every year. Also, the qualified basis is the proportion of a basis in the entire project allocable to use by low-income tenants. So that is the basis that we are talking about. If this building will be designed for the use of low-income tenants and other tenants, then not the whole basis, not the whole value of the building will qualify as the qualified basis for purposes of calculating this credit. So now let's look at another credit, the disabled access credit. This is a credit for eligible access expenditures made by small businesses, meaning you have an old building and you need to make this building accessible for disabled individuals. If you do that, then we're going to give you a credit. The credit would be 50% of expenditures that exceed $250, but not in excess of $10,250. So if you make that calculation, you're going to know that the maximum credit allowable in this case will be $5,000. So it's just 50% of the expenditures that exceed $250. An example, let's say that your expenditures are $7,000. So if your expenditures are $7,000, the credit amount will be 50% of the expenditures that exceed $250. So you have to reduce 7,000 minus 250. 6,750 is the amount of the expenditures, but the credit would be 50% of that times 50%. So the amount of the credit would be $3,375 as long as it's less than $1,000. Now, property tax basis will be reduced by the amount of the credit. So whatever your basis on the property is, you will have to reduce by the amount of the credit that you are claiming. So keep that in mind. Another type of credit is the energy credit. So this credit is available to businesses that are trying to use alternative energy like solar energy. And since they are investing money or spending money in using this alternative energy, we want to reduce their cost by giving them this type of credit. The credit cannot be more, or I guess I credit for small employer pension plans startup cost. Small businesses can claim a non-refundable tax credit for the cost of setting up these plans. And what is a small business? It's a business with less than 100 employees who have earned at least $5,000 in compensation. The credit amount will be 50% of the cost of setting up these plans. And also, the maximum amount of the credit is the lesser of either $5,000 or $250 times the number of non-highly compensated employees. And we already know who is not a non-highly compensated employee, right? Anybody who is making less than $160,000 is a non-highly compensated employee. So if I have 10 employees who are non-highly compensated, then the maximum credit will be what? 5,000 or 250 times 10. I think $250 times 10. $2,500. That is the maximum amount of credit that I can claim as the small employer pension plan startup cost credit. The deduction for startup cost is reduced by the amount of the credit. That's also very important. You cannot get a double benefit, okay, with any business-related credit that we have reviewed so far. Credit for employer-provided childcare. Employers can claim a credit for providing childcare facilities to their employees during normal working hours. And there's a limitation, $150,000. This will be for an employer that is creating a facility and setting up a room to provide childcare. The credit amount is calculated actually by multiplying 25% by the qualified childcare expense, plus 10% of qualified childcare resource and referral services. What are these services? Well, these type of programs that help employees find childcare. So the deductible qualifying expenses must be reduced by the credit amount. If you're getting a credit, you have to reduce your deduction. Now, the amount of the credit has also an impact on the basis of qualifying properties. So you have to reduce your basis by the amount of the credit that you are claiming. If within 10 years of being placed in service, a child care facility ceases to be used for a qualified use, the taxpayer must recapture a portion of the credit previously claimed. So you cannot stop providing this facility within 10 years of setting up this establishment. Otherwise, you will be subject to a recapture. Recapture just means that you have to pay back part of the credit that you have received. Credit for employer-provided family and medical leave. So here we are giving an employer a tax benefit because they are paying wages to the employee that has to be absent because of a medical condition of himself or herself or their family. And this credit is equal to 12.5% of the wages paid to this qualified employee. To claim this credit, employers must pay a minimum of 50% of the wages normally paid to an employee during the leave. So there are certain things that you need to remember. First, it needs to be an employee, okay? Then you have to pay a minimum of 50% of wages that you normally pay this employee. If you're paying more money, more than 50% of the wages, because the minimum is 50% of the wages, if you do that, you get 12.5%. But if you're paying more, you can get up to 25% of the wages paid to the employee. Okay. Also, the credit is limited to 12 weeks of leave per employee during any taxable year. Also, the employer must have a written policy in place that allows all qualifying full-time employees no less than 2 weeks of annual pay, family, and medical leave. So there has to be a policy, another requirement, okay? A written policy where they are saying, hey, we have this program where we are going to pay at the minimum 2 weeks of family and medical leave. That doesn't mean that they have to pay at a minimum 2 weeks. It's that the policy, the written policy has to say that. I mean, You can be on family leave for like 3 days, 5 days, a week. It doesn't matter, but the policy has to have these specific provisions in order to satisfy the requirements. Changes under OVA. This provision was scheduled to terminate before 2026, but thanks to OVA, now this credit is permanent. Also, the benefit has been expanded. Before you, if you were an employee, you were required to work at a minimum of 1 year. Now, the restriction has been reduced. You can be a qualifying employee for this benefit as long as you have been working for the employer for 6 months. Now, there is another provision that applies. This provision also applies to employees working at least 20 hours per week, not just full-time employees. Okay, so now let's talk about foreign tax credit and individual tax credits. Okay, both individual taxpayers and corporations may claim a tax credits for foreign income tax paid on income earned and subject to income tax in another country. So what's happening here? You're working in another country and you're paying taxes, but you know that you have to file a 1040 here in the US because you are a US citizen, and you are going to have to include that income in your tax return. So if you have paid already your taxes in another country, you will be able to get a credit. There are certain limitations, but the most important thing is that we have this benefit to reduce your taxes. Now, a taxpayer can claim either a deduction or a credit, but the taxpayer will generally choose a credit because the credit reduces your taxes, but a deduction just reduces your taxable income before your tax is calculated. The foreign tax credit is generally advantageous, so for that reason. The foreign tax credit is designed to mitigate double taxation, as I mentioned. Generally, if you have paid taxes and your tax rate is 15%, that's great. But if your tax rate in the US is a little bit higher, you will have to pay the difference here in the US. So generally, that is how it works. Also, we have a formula to calculate the foreign tax credit because you cannot get a credit for the amount that you have paid. Sorry to tell you that. So, the foreign tax credit for any given tax year is the lesser of the foreign taxes paid or incurred or the overall limitation. So we have to calculate the foreign tax credit limitation and compare it to what we have actually paid. Whatever amount is less, that is the foreign tax credit that you will be allowed to take in any tax year. What's going to happen with the rest of the taxes that I pay? Don't worry, you are not going to lose that. You can carry back to 1 year or carry forward up to 10 years, but you're not going to lose the credit. So, how do we calculate that foreign tax credit limitation? You start with your US tax on your worldwide income. You're going to multiply that by the foreign source taxable income divided by your worldwide taxable income. So, the formula is here. So now we need to calculate the foreign tax credit limitation. Whenever we're going to calculate the foreign tax credit limitation, we need important information. We need to know what is your US tax on your worldwide income. We need to know what is the foreign source taxable income and what is the worldwide taxable income. So first, we need to calculate what is your tax on your worldwide income, but the US tax, then we're going to multiply that by the foreign source taxable income divided by the worldwide taxable income. So we're going to review an example in a second. But before we get there, I just want to mention that only income taxes, world profit taxes, and excess profit taxes will qualify for the credit. Okay. Any value added taxes, severance taxes, property taxes, sales taxes, all those will not qualify whenever you are computing the foreign tax credit. Okay. So now let's look at this example. Ian is a US citizen who is married and files a joint tax return. in the tax year 2025, Ian earned a total of $90,000 in income, which came from three sources: $60,000 earned in the United States, $10,000 earned in a foreign country with a 15% tax rate, where he paid $1,500 in foreign taxes, $20,000 earned in another foreign country with a 50% tax rate, where he paid $10,000 in foreign taxes. Can you imagine? 50% tax rate. In the US, it could be up to 37%. So he had paid a lot of taxes, and now we want to know how much is the foreign tax credit. And we know that is the lesser of the taxes that Ian pay versus the foreign tax credit limitation. So now we need to know what is the amount of foreign tax credit that Ian can claim, and is the lesser of the taxes actually paid or the foreign tax credit limitation. So that is what we are going to calculate right now. So Ian paid a total of $11,500 in foreign taxes. Before applying any credits, Ian's US income tax liability is $11,034. However, the IRS limits the foreign tax credit based on the proportion of Ian's income that was earned abroad, and the formula is as follows. Foreign tax credit limitation is equal to foreign source income divided by the total income, worldwide income, times US tax liability. So the limitation is foreign source income, how much he had made outside of the US. 10,000 plus 20,000, that's $30,000. What is the total income? Worldwide income, $90,000. The US tax liability, $11,034. So the limitation will be 30,000 divided by $90,000. You will multiply the US tax liability, which is $11,034. What is the total amount of the foreign tax credit limitation? It will be $3,678. Now, what is the foreign tax credit? It will be the lesser of the tax paid, $11,034, and 3,678. So the lesser is 2,678. Even though he paid 11,500 in foreign taxes. So the unused portion is not lost. He is gonna be able to carry back 1 year or carry forward up to 10 years, potentially reducing future tax liabilities or amend the tax return that he had previously filed to reduce his taxable income in a prior year. But he's not gonna lose this amount. Okay, so now we're going to talk about the earned income credit. This is a very important credit and is subject to scrutiny often because the IRS has encountered many situations where people have been claiming this credit without qualifying for it. Okay, and why people are so inclined to get this credit? Well, because this is a refundable credit, and the amount that you can get, depending on your qualifying filing status and the number of qualifying children that you have, is significant. As you can see here, the amounts for a married taxpayer, a married couple filing jointly with one qualifying child, gives you an earned income credit of $4,328. Okay, and it is increased depending on how many children you have. Okay, so let's learn about this. The earned income credit is determined by multiplying the earned income, meaning anything that you have earned as wages or as earnings from self-employment, anything that is not passive income. So you have to take this amount and you need to multiply this by the applicable credit percentage. There are different base amounts and different percentages, and it can be confusing. That's why the IRS provides a table for you to apply. And I'm going to show you a table in a second. But for now, just remember that you have to multiply your earned income by the applicable credit percentage. Okay? So as I mentioned here, for a married couple filing jointly with one qualifying child, the credit percentage will be 34%. And your base amount meaning the amount that you have to reach to get the maximum credit will be $12,730. So you multiply that amount by 34%, that's when you get your maximum earned income credit. For two qualifying children, the maximum earned income credit will be $7,152, which is the amount that you get by multiplying $17,880 times 40%. And if you have three children or more, then the amount of credit that you're going to get is $8,046, obtained by multiplying 17,880 times 45%. Okay? So here, again, we have the applicable percentage tax rate times the earned income. And this rate is the maximum amount of earned income determined by the number of qualifying children, as you saw previously. We need to see how many children you have, and also we need to see your filing status. Then there's another amount that you need to remember. Before you were looking at, hey, how much income do I have to make to get the maximum amount? So this is the amount of earned income that you have to make to get the maximum amount. But there will be a time where you start losing this earned income credit. And whenever you reach the phased out base is when you're going to start losing the earned income credit. So, for example, for a couple that is filing jointly and has one qualifying child, that amount will be $30,470. If they reach this amount, they are going to start losing the earned income credit. So that is for a married couple filing jointly with one qualifying child. For any other taxpayer, head of household that is filing a tax return and has one qualifying child, the phase out base, the phase out amount will be $23,350. So I'll show you a table in a second, but let's look at the formula to see how the phase out base applies. So first, we start with calculating your maximum credit. And for a married couple with two children, your maximum credit will be $7,152, which is obtained by multiplying your earned income base times the applicable percentage. So your maximum credit for a married couple with two children will be $7,152, obtained by multiplying your earned income base times your applicable percent. Okay. After that, if you reach a certain amount, which in this case is $30,470, the tax credit starts to phase out, starts to decrease. How so? Well, we have to apply a particular formula. We have to multiply the excess amount over the phase out base by a percentage that is provided in the table to reduce our maximum earned income credit. In this case, for example, the phase out rate for a married couple with two children would be 21.06%, meaning for every dollar above $30,470, the credit is reduced by about 21 cents. So here in the example, the credit will become zero when the taxpayer or this couple reach $64,430. So here we have the maximum earned income credit, $7,152 minus the credit percentage times any amount in excess of the phase out amount. So the maximum amount would be $64,430. I'm going to give you an example in a second, but I just want you to get the general idea. So, and for you to understand, the earned income credit reaches the maximum point once this couple earns $17,880. Then it will stay in an area of like a plateau, will plateau. You will not lose the benefit if you make $18,000, make $20,000, $25,000. As a couple, if you're earning that amount of money, you still are going to get the maximum credit. But once you reach $30,470, that's when you're going to start losing the benefit and the benefit of getting the earned income credit. And once you reach $64,430 as earned income, you're going to completely lose the earned income credit. Okay. And we apply this formula. We're going to have time to practice. Just get the idea. In this case, the applicable percentage is 40%. So your maximum earned income tax credit in this case is $7,152. And then if you make more money, if you make 18,000, 20,000, 25,000, you still get $7,152. Only when you reach $30,470, meaning the phase out base, is when you're going to start losing your earned income credit. So we calculate first our maximum credit, and we're going to reduce it by the applicable phase out percentage. And in this case, for a married couple with 2 children, it would be 21.06%. So we're going to multiply that by the difference between whatever you're making as earned income and the phase out base, and that result will be the amount that will reduce your earned income credit. So again, the excess over the phase out base, the excess needs to be multiplied by the phase out percentage, which in this case is 1.06%. So the result of this amount will reduce your credit. So your earned income credit will be reduced by that amount, whatever it is that resulted from multiplying the phase out percentage times the excess over the phase out base. So the tax credit becomes zero when your income reaches this particular amount. Okay. And how do I calculate the reduction? Well, the reduction will be the phase out percentage provided in the table times the excess over the phase out base. In this particular situation, this couple is making $64,430 as earned income. So we have 64,430 minus the phase out base, 30,470. That gives us $33,960. You're going to multiply that by 21.06%. And that gives us exactly 7,152. So maximum credit would be decreased by 7,152. The result is zero. So you end up with no earned income credit once you reach this amount. Okay, so what am I talking about? I mean, it's kind of hard to see it there, but here you're gonna see it a little bit better. So this is a table that is provided by the IRS. You start with your filing status, with how many children you have or the taxpayer has, and then you start analyzing the table. So first, you start with your earned income base amount. The earned income base amount indicates the amount of income that will give you the most earned income credit. That's it. That's the importance of the earned income base amount. And as you can see, the earned income base amount is different depending on who is your taxpayer. So the first line, the line that I have here in orange, is showing you that the married filing jointly, a married couple filing jointly with no children will make the most or will receive the most credit once they reach $8,490 as earned income. If they earn $8,490, they will get the maximum credit of $649. That's it. That is the only information. I mean, that's the most important information that the earned income base amount is telling you. So whenever we want to know what is this earned income base amount, what is that? Well, this is the income level at which the maximum credit is reached. The income level at which the maximum credit is reached. And what is the credit that I'm going to get? Well, this earned income times the credit percentage. This will give you $649. This is the maximum amount of the credit that you can get as a married couple with no children. If you are making $9,000, for example, you are going to get the same credit. $10,000, same credit. $15,000, same credit. But there will be a point where you are not going to receive the maximum credit anymore. In fact, you're going to start losing your earned income credit. Okay. And when is that? Well, when you reach the phase out base. So the phase out base is the income level at which the credit starts to decrease, starts to phase out. In this case, for a married couple, no children, the phase out base will be $17,730. Okay. And what are you going to do there? Then you're going to start decreasing this maximum credit by the excess over this phase out base, multiplied by the phase out percentage. Okay, so now let's go back to the married couple with two children that we talk about. Here, you're here. They have two children. The maximum credit, as you can see here, is $7,152. This is obtained by multiplying the earned income base amount times the credit percentage. Okay, so we are here. The earned income base amount times the credit percentage. The earned income base amount is the income level at which the maximum credit is reached. And in this case is $17,880 times the credit percentage, which in this case is 40%. So now that you have your maximum credit, then if you make $19,000, $20,000, $25,000, you're fine. You're still going to get this maximum credit. However, once you exceed this phase out base, then you're going to start losing your credit. Your credit is going to be reduced. One more time, how is your credit going to be reduced? Well, this maximum amount will have to be reduced by the excess over the phase out base multiplied by the phase out percentage. And once you reach this amount in this column, then you are not getting any more earned income credit. So in our example, the amount was $64,430. Okay, so let's go back there. Now that you have seen the numbers, hopefully you can remember. So credit is zero because we have taken the maximum credit here minus the phase out percentage multiplied by the excess of your earned income over the phase out base. Okay, so let's look at another example. If we have other taxpayers, head of household, single taxpayers with no children, you see here the earned income base amount for a taxpayer with no children will be $8,490. Great. And the credit percentage here is 7.65%. So the maximum credit would be $649. Perfect. The phase out amount, because here so far you're like, okay, why do we have these different numbers or lines if the numbers are the same? Here, yes, the numbers are the same so far, but the phase out base changes depending on your filing status and the number of your qualifying children. Okay, so here, as you can see, the numbers are not the same anymore. You start losing the earned income credit once you reach, if you are single or a household, this threshold amount, $10,620. Okay. And your phase out percentage is kind of the same for married filing jointly, depending on how many children you have, but the phase out base amount changes. Okay. And also the phase out ends at different income levels. Here the numbers are different. So that is something that you need to keep in mind. We also have the numbers for tax year 2024, but they are kind of irrelevant. So let's just focus on 2025. Okay, here, now let's look at an example. Example 20. It says, Grace and her spouse file a joint return. In 2025, the couple who have one qualifying child earns a total of $32,000 of wages, but has no other income. Okay, so we have a couple with $32,000 of wages, $32,000 of earned income. So the couple's earned income credit is $4,084. That is the maximum amount. But here, let's go and see the table. So a couple, we are here with one qualifying child, they have $32,000 of earned income. So they have exceed the phase out base, exceed the phase out base. Okay, perfect. We know that, so we're gonna have to reduce our maximum earned income credit by whatever amount we calculate here. So first, if we look at the table, we are gonna see that it is 4,328, which is the result of multiplying the earned income base amount times 34%. Okay, so yeah, we have our maximum earned income credit of 4,328. We are gonna reduce this by the applicable percentage for a couple with one qualifying child, applicable percentage for a couple with one qualifying child will be 15.98%. Great. We have that times the excess over the phase out base. What is my phase out base? The phase out base for a couple with one child is $30,470. The excess is $1,530. Okay, that's the excess, and we're gonna multiply that times 15.98%. That gives me $244. So our maximum earned income credit would be reduced by 244, and that will give me an ending earned income credit of $4,084. Okay, so we are reducing our maximum earned income credit by this amount that we calculated here, and that will give us an earned income credit of $4,084. Now let's look at another example. Instead, the couple had 3 or more qualifying children. Their maximum earned income credit is $8,046. Okay, so we start there. Let's go back to the table. This is a couple with 3 children. So couple with 3 children, what is the maximum amount of the credit? 8,046, okay? Which is the result of multiplying the earned income base amount times the credit percentage that give us the maximum credit of 1,046. Great. Now, this amount needs to be reduced by, the particular phase out percentage times the excess over the phase out base. And what is that? Let's find out what is the particular phase out percentage. For a couple with 3 or more children, the phase out percentage is 21.06%. 21.06% times the excess over the phase out base. So this couple has $32,000 of earned income. So the excess over the phase out base would be the same. And I forgot how much that was. The excess would be 1,530. So 1,530, 21.06%. So that gives us $322. Great. So we are gonna reduce our maximum earned income by this amount, okay? And our ending earned income credit would be 7,724. 7,724. Okay, hopefully with those examples, now you have a better idea of how an earned income credit is calculated. Another important information that you need to keep in mind is that taxpayers with no children, I guess you have seen that by looking at the table, can get this earned income credit, but they have to satisfy additional requirements. For example, taxpayers need to meet a particular age requirement, ages 25 through 64, and they cannot be claimed as dependents. Here, there's no age requirement for taxpayers with children. But whenever we're dealing with single taxpayers or any other taxpayers that have no children, we need to make sure that we satisfy the age requirement as well. Okay? In 2025, the tax credit amount for a married couple filing jointly with no qualifying children is 7.65% times the earned income, up to $8,490. We have seen that in the table, so I'm not going to repeat it. The tax credit begins to phase out when earned income exceeds this phase out base amount, which in this case is $17,730 for married taxpayers filing jointly. For other taxpayers, the phase-out base amount is $10,620. Okay, perfect. Now let's look at the child and dependent tax credit. This credit is a very important credit as well because it is a refundable credit and is based on the number of qualifying children and dependents that the taxpayers have. An eligible children for purposes of this credit is somebody under the age of 17, a U.S. citizen, and dependent of the taxpayers. So the children need to meet those requirements. You can get up to $2,200 per child or $500 per non-child that is your dependent. Another important thing that you need to remember is that the credit phases out as your adjusted gross income exceeds $400,000 if you're married filing jointly or $200,000 for other taxpayers. Also, this tax credit has a refundable part up to $1,700 per child, but no more than 15% of earned income in excess of $2,500. So in 2025, the child tax credit is partially refundable up to $1,700 per child, but no more than 15% of earned income in excess of
$2,500. Another important thing to remember is that dependent tax credit, the $500, is a non-refundable amount. Okay, and this was supposed to expire, but because of OVA, this has become a permanent provision. So here are more details. The child credit was increased to $2,200. Before it was just $2,000, and the dependent credit became a permanent provision. Okay, so please remember that. Okay, credit for child and dependent care expenses. So who qualifies? You can qualify if you have a dependent under age 13 or if the dependent or spouse is physically or mentally incapacitated and lives with the taxpayer for more than half of the year. The credit is of the specified percentage of child and dependent care expenses. In general, is equal to a percentage of unreimbursed employment-related expenses up to $3,000 for one qualifying individual and $6,000 for two or more individuals. The credit rate starts at 35% and is reduced by 1% point for each $2,000. So let's look at the table. So here's the table. If you're making $0 but not more than $15,000, then your applicable rate would be 35%. So 35% of your expenses can be claimed as a credit. And the rates will decrease as you make more income. For example, if you are making over $41,000, but not more than $43,000 as income, your applicable rate of the credit will be 21%. For any other taxpayers that are making more money, that are earning more, the applicable rate will be 20%. The eligible employment-related expenses. Eligible employment-related expenses includes amounts paid for household services and care for a qualifying individual. Now, this care can be provided in the home or outside the home of this particular taxpayer. So if the care is provided outside the home, we need to make sure that the dependent or the spouse that is receiving care is spending at least 8 hours a day within the taxpayer's home for the taxpayer to qualify for this credit, okay? Earning income credit ceiling. The qualifying employment-related expenses are limited to an individual's earned income. For married taxpayers, this limitation applies to the spouse with the lesser amount of earned income. Okay, whenever we're calculating this, the credit for child and dependent care expenses, first, we said, hey, it can be up to $3,000 for one qualifying child or $6,000 for more individuals. And then we learned that, hey, we look at the expenses and then we apply an applicable percentage. And that is how we arrive to this number, either $3,000 if you just have one qualifying individual or $6,000 for more. But now we are introducing you with additional information. There is a ceiling, the earned income ceiling. And what happens if we have a spouse that is not working? No worries. If one of the spouses is not working, then we're going to deem that they are earning $250 per month if there is one qualifying individual in the household, or $500 per month if there are two or more qualifying individuals in the household. Okay, so how do we calculate the credit? The credit will be equal to a particular percentage that we have already reviewed of unreimbursed employment-related expenses up to $3,000 for one qualifying individual and $6,000 for two or more individuals. Credit rate starts at 35% and is reduced by 1% point for each $2,000. Okay, I think that is enough. Now let's look at the education tax credits. We are very familiar with these credits, right? Because maybe we're claiming the credit, the American Opportunity Tax Credit or the Lifetime Learning Credit. But as students, you could potentially get one of these credits. Both credits are available for qualifying tuition and related expenses. What related expenses? Books and other course materials. Those are the expenses that will qualify. Um, Room and board, you generally need to spend money on this, but unfortunately, these are not qualifying expenses for education tax credit purposes. What is the maximum credit? Well, if we're analyzing the American Opportunity Tax Credit, the maximum amount will be $2,500 per year for the first 4 years of post-secondary education. Okay, $2,500 per year for first 4 years of post-secondary education. 100% of the first $2,000 of tuition plus 25% of the next $2,000 of tuition expenses. That will give you $2,500. Now, if we are analyzing the lifetime learning credit per taxpayer, the maximum amount will be 20% of qualifying expenses, up to $10,000 per year. Cannot be claimed the same year that you're claiming the American Opportunity Tax Credit. That's another important thing. Eligibility requirements. Well, you could claim this credit for your spouse, for your dependents. And that's why many of you that are very young have seen your parents claiming these credits because if you are under 24 years of age, you know that you can still be qualified as a dependent. We have reviewed those rules before. And if you're studying, then who's going to claim this tax credit? Well, your parents. Okay. So your parents will get this credit for you, your education expenses. To be eligible for American Opportunity Credit, the student must take at least one half the full-time course load for at least one academic term, okay, one semester. So at least one half of the full-time course load for at least one academic semester to qualify for this credit. The lifetime learning credit doesn't have this particular requirement. Now, limitations. Both education credits are subject to income limitations. Both will phase out beginning the taxpayer's modified adjusted gross income of $80,000. If the taxpayer adjusted gross income reaches $80,000, a single taxpayer or a head of household taxpayer, then you're going to start losing these credits. Income limitations. Both education credits are subject to income limitations. For example, for merit filing jointly, you will start losing this credit if you reach $60,000 of income, or you start losing this tax credit if your adjusted gross income is $160,000 for merit filing jointly taxpayers. And for single or head of household, you start losing this credit if your adjusted gross income $80,000. So the credit will be reduced proportionally over $10,000. You will completely lose the credit if you are single and your AGI is 90,000. Also, another important information that you need to keep in mind is that 40% of the American Opportunity Credit is refundable. What does that mean? $1,000 of the American Opportunity Tax Credit is refundable. And then the other part is non-refundable. The lifetime learning credit is not refundable. And we already mentioned that you cannot claim both tax credits together in one single year. Okay, so here let's review the big picture scenario. We have Tom and Jennifer. They are married. They are filing a joint tax return. Their adjusted gross income is $158,000, and they have two children, Laura and Sam. Laura is a freshman and Sam a junior, and they are full-time students. They are Tom and Jennifer's dependents, so they satisfy these important requirements. Now, the Snyders, meaning Tom and Jennifer, pay the following education expenses: $7,500 of tuition and $8,500 for room and board for Laura, $8,100 of tuition plus $7,200 for room and board for Sam. You already know that you can ignore the expenses incurred for room and board, right? That is something that you can get from this. Okay, perfect. Laura's tuition and Sam's tuition are qualified expenses for the American Opportunity Credit. For 2025, Tom and Jennifer may claim a $2,500 American Opportunity Credit for both Laura's and Sam's expenses. So we're going to calculate here 100 times $2,000 plus 25% of the remaining $2,000. Okay. What are we calculating? We're just calculating the amount of the credit that this couple can claim as American Opportunity Credit for Laura. And the rule says that 100% of the first $2,000 of tuition or other qualified expenses plus 25% of the additional $2,000. So that will give you $2,500 per child for both Laura and Sam. You see here their tuition is $7,500, $8,100. So they definitely are gonna get $2,500 each. Then now assume that Tom and Jennifer's modified adjusted gross income is $172,000 instead of $158,000. Remember that we said that there are income limitations. If you make more than $160,000, you start losing the credit. Actually, you completely lose the credit if you make more than $180,000. Okay, so how do I calculate the amount that I'm not gonna receive? Well, first, you need to calculate the excess over the phase out base amount, which in this case is 160,000. So the excess will be $12,000. Okay. 12,000 over 20,000, that is 60%. So that is the amount of the reduction. So your initial $5,000 will be reduced by 60% of that amount, or said in another words, you qualify for 40% of the American Opportunity Tax Credit. Okay, so the American Opportunity Education Credit would be 40% of $5,000, and that will give you $2,000 instead of $5,000. And the only difference between claiming the $5,000 is that you have too much adjusted gross income. Okay, before the adjusted gross income was 158. In this case, the adjusted gross income is 172,000. Now let's look at this example. Now assume that Tom and Jennifer's modified adjusted gross income is 160,000. In addition, assume that Tom is going to school on a part-time basis to complete a graduate degree. So he pays qualifying tuition and fees of $4,000 during 2025. Okay, so Tom is going to school. Tom's qualifying tuition and fees are eligible for the lifetime learning credit. You know why they are not eligible for the American Opportunity Tax Credit, right? Because he's completing a graduate degree. This is not post-secondary education. So the potential lifetime learning credit is $800, 20% of $4,000. Okay, so in this case, the qualifying tuitions and qualifying expenses is $4,000, and 20% of that is $800. However, this couple had an adjusted gross income that exceeds $160,000. So we need to apply a limitation here as well. The same limitation that we apply to the American Opportunity Tax Credit needs to be applied here. So we are going to first calculate the reduction amount, and it's the same, it's 60%, because the modified adjusted gross income exceeds the $160,000 limit by $12,000, and the phase-out range is $20,000. So the couple's lifetime learning credit is reduced by 60%. As a result, the lifetime learning credit is $320. Okay? And their total education credits amount to $2,320. American Opportunity Credit of $2,000 and Lifetime Learning Credit of $320. Residential energy credits. These credits are meant to encourage individuals to make their home more energy efficient. And the amount of the credit is about 30% of the sum of the following expenditures: qualified energy efficiency improvements, residential energy property expenditures, home energy audit expenditures. So what you need to know about this credit is that the energy efficient home improvement credit gives individuals a credit each year equal to 30% of the sum of the following expenses that they have incurred on during the year. So we have 3 qualified energy efficiency improvements installed in the current year. And here we are talking about expenses in changing the windows, for example, doors, or insulation that protect the home from the elements generally. Then we have residential energy property expenditures paid during the year, and these expenses are generally related to energy efficient heatings or cooling systems in the house of a particular taxpayer. Then we have a home energy audit expenditure. So this is the amount of money that we're paying to a professional to evaluate the home and see if the home is actually energy efficient. Another important detail that you need to remember is that the total maximum credit available here is just $1,200. So it doesn't matter if you have spent $10,000, the maximum credit available is just $1,200. Also, there are particular caps that you need to keep in mind. The maximum annual credit available for windows or skylights is just $600. For doors is $500. Energy property expenses is $600. Qualified home energy auditor expenses is $150. So it doesn't matter if you have paid $1,000 to this professional to conduct the audit in your home. You just gonna qualify for 30% of that amount, and it is capped at $150. So 30% of $10,000 is $3,000, but you cannot claim $3,000 amount. You can only claim $150 for that expense. And what happens with the excess? Well, unfortunately, the excess is non-refundable and is not available for carryover. Here we have example 28 where you can kind of analyze this more clearly or see the numbers more clearly. Amy decides to explore how she might reduce energy cost of her primary residence. So in March 2025, she pays $600 to a certified home energy auditor for an examination of her home. Then later in the year, Amy paid $1,200 to have 2 windows replaced. In 2026, she also spent $600 to have a central air conditioner installed that met the highest efficiency tier per consortium for energy efficiency. Her tax liability for the year exceeds $15,000. Amy will generate an energy efficient home improvement credit for 2025 of $510 and for 2026 of $600. And we're going to see here in this next slide how that happened. The energy efficient home improvement credit allows Amy to claim 30% of qualified expenses, but each category has limits, as we just learned. So in 2025, she spent $600 on energy audit. 30% of that amount is $180, but she is capped at $150. Then she spent $1,200 on windows. 30% of that amount is $360, which is under the $600 cap. Okay, so she will qualify for $360 because that is the 30% of the expense amount. The total credit for 2025 would be $150 for the energy audit plus $360, and that gives you $510. In 2026, Amy spent $4,600 on high efficiency air conditioner, and 30% of that amount is $1,380, but that amount is capped at $600. So that is the total amount of the credit that she qualifies for tax year 2026. Okay, so that is important to remember. So even though the percentage calculation might give a higher number, the law imposes category specific caps and this particular annual limit of $1,200. Another important credit is the residential clean energy credit, and this is provided to individuals who may also claim 30% credit for certain alternative energy property, including solar panels, heat pumps that they have installed in their principal home. Any credit in excess of tax liability for the year can be carried forward. But that has changed because of OBA. The credit now remains at 30% for qualifying property installed and placed in service by the end of 2025. After this year, this credit will not be available anymore. So that is something that you need to remember because of OBA. The credit is going to disappear by the end of the year, 2025. Okay. Next, we have the clean vehicle credit. Here, with this credit, you were allowed to get a credit of $7,500 for the purchase of a clean vehicle. And if the buyer had prove and show that the vehicle had a certain battery with a specified percentage of its components manufactured or assembled in the US, they could also claim a additional amount of $3,750. In the year of purchase or the preceding year, the buyer's MAGI, modified adjusted gross income, should not exceed $300,000 for married couples filing jointly, or $225,000 for head of households, or $150,000 for single taxpayers. So that was a threshold. But according to OBA, this clean vehicle credit is set to expire after September 30, 2025. Okay, we also have the previously owned clean vehicle credit. This was 30% of the sales price, not to exceed a credit of $4,000. So a qualified buyer must not have claimed this credit in 3 years. We also have the previously owned clean vehicle. This was applicable whenever a buyer was purchasing this type of vehicle, and they were qualified to receive 30% of the sales price, not to exceed $4,000. And there were limitations related to their modified adjusted gross income, MAGI. But because of OBA, this provision is also set to expire in September 30, 2025. Okay, so now let's look at the retirement plan contributions, the credit related to the retirement plan contributions. This was also called the Savers Credit. So the credit was enacted to encourage low and middle income taxpayers to contribute to qualified retirement plans. The amount of contribution, the maximum amount of relevant contribution was $2,000, and the credit was for 50% that amount. The allowable credit depended on the adjusted gross income of the taxpayer. So here in the table that I have for you, you can see that for joint tax returns, for any couple filing a joint tax return that were making no more than $47,500. The credit for the retirement plan contribution was 50% of the contribution. So the amount of the credit for them was $1,000 or is $1,000. So now if you're looking at head of household, you could not make more than $35,625 if you wanted to get the 50% credit on your contribution. Similarly, with other taxpayers, and now we're talking about married filing separately or single taxpayers, they will qualify for the 50% contribution credit, meaning $1,000, if their adjusted gross income was not over $23,750. Okay, so what happened if you were preparing a tax return for a couple filing jointly and they had $80,000 of adjusted gross income, and they made a contribution of $2,000 to their retirement account. Well, in that case, they will receive no credit at all because they exceed the amount of the threshold. You see, for anybody who's making, any couple filing a joint tax return that is making more than $79,000 as adjusted gross income, the tax rate, the applicable percentage, the for the credit is 0. So any married couple that is filing a joint tax return and that have an adjusted gross income over $79,000 will not see any of this credit. So now looking at this chart, for example, if we were preparing the tax return of a couple that are married and they're filing jointly and their adjusted gross income was $60,000, then the amount of the credit that they will claim is 10%. So in that case, you would just multiply 2,000 times 10%, and the amount of the credit would be $200. Here I have added other information regarding the retirement plan contribution because BOBA if has changed a little bit. So the maximum amount of contribution has been for a single taxpayer, $2,000. This has not changed. The maximum credit that any individual could claim was $1,000. But if we were preparing the tax return of a couple, then the maximum amount would be $2,000 for married couples. Also, the maximum amount is going to change in 2027 because it's going to be adjusted for inflation. So the amount of contribution will increase up to $2,100, okay, making the credit for any individual up to $1,050, and for any married couple, $2,100. So that is the change that was recently enacted. Payment procedures. So now we're going to talk about how do we pay the taxes owed to the IRS. First, we calculated the amounts. We know how much taxes we owe. We have hopefully applied certain tax credits that have reduced our tax liability. And now we need to pay to the IRS. How do we do it? Well, the main responsible of sending this money to the IRS is your employer through certain withholdings. Okay. So they are in charge of sending withholdings amounts to the IRS. And sometimes they're also responding on, and sometimes they're also responsible for the payment of taxes. And what kind of taxes we're talking about? FICA taxes, because they have to match the amount that you have to pay. Okay. So what are FICA taxes? They are a couple of taxes that you're responsible for, and I am referring to the Social Security taxes and the Medicare taxes. The Social Security taxes is just 6.2% of your first 176,100 of wages. Any amount in excess of this threshold will not be subject to any additional Social Security taxes. And if for whatever reason you have paid or you have an amount that has been withheld for Social Security, that amount will have to be returned to you as a refundable credit when you prepare your tax return. Then we have the Medicare taxes. Here, we just apply 1.45% to your wages, and there's no wage limitations. If you're making $300,000, for example, only the first 176,100 of wages will be subject to Social Security tax of 6.2%, but the whole amount will be subject to Medicare tax of 1.45%. And based on that threshold amount, let me tell you, you are going to probably have to pay an additional Medicare tax. Okay? We're going to look at that in a second. How do we report this to the IRS? How do we send the money to the IRS? Well, whenever you get hired, the first thing that you have to complete is a Form W-4 and give that to your employer, indicating your Social Security number, your marital status, the number of dependents or qualifying children that you have. Why do we do that? Well, we do it because the employer is trying to calculate what is the amount that they have to retain and send to the IRS. So that's why this is very important. You are also familiar with the Form W-2, right? Because this is what you receive every month. That is a summary of your wages, includes the amount of the withholdings, the amount of your FICA taxes, includes, information about your contributions towards your retirement plan and more. So that is a form that gives you a lot of information you receive very often during the year. If you are a self-employed individual, obviously you're not going to receive any of this information, right? Because you are employing yourself. Now, backup withholding. Generally, it is required if a taxpayer does not give a social security number and the payer of a particular income, interest income. Here we have the example of a bank. The bank will have to pay you interest income, for example, where they will retain 24% of the gross income and send that to the IRS. So there is a backup withholding whenever a taxpayer doesn't provide their social security number. Now, one thing that I just want to mention generally, how the withholding is calculated. How do we know? Well, in the W-4 form, you have included a lot of relevant information. So whoever your employer is, they are going to make certain calculations, or their system is going to make certain calculations. They're going to account for, hey, we're going to pay you in salary this amount, and based on deductions, and we're going to just apply the standard deduction, we are calculating that approximately you fall within the, I don't know, 24% tax bracket. And if that is the case, we are going to start withholding 24% of your wages, and we're going to send that to the IRS. That is how generally works. Estimated tax payments to avoid penalties for underpayment. The question here is, how am I going to send estimated payments if I don't know? Well, here we are dealing with a taxpayer that knows how much more or less is the amount of tax that they owe. So they need to send estimated payments. So to avoid penalties for underpayment, you must annually pay the smaller of 90% of the current year's tax or 100% of the last year's tax. So the scenario that we're reviewing here is a taxpayer that knows more or less how much in taxes they're going to owe. So they need to make sure that they take steps to send this money to the IRS. But if you know that you're going to be a high earner, you're going to make more than $150,000 for a married couple, or $75,000 if you are married filing separately, or any other taxpayers, then you have to make estimated payments in the amount of 110% of your last year's taxes. Okay? So that is something that you need to remember. When is the estimated payment made? In parts, you send quarterly payments. The first fourth of the required annual payment is due in April 15, then June 15, September 15, and finally January 15 of the following year. So that's when you send the estimated payments. There is a penalty for underpayment, and we don't want to pay that. That is why we are trying to make these calculations and send the estimated payments on time. Penalty for underpayments, non-deductible penalty. Here you cannot deduct this as an expense. It's non-deductible, and it's a fine, a penalty that you have to pay because you are underpaying your taxes. You are not sending the estimated amount. You're not sending that, and at the end of the year, there is an underpayment of taxes. If that is the case, then you're subject to the penalty. The underpayment occurs when any installment is less than 25% of the required annual payment. And the penalty is 25% of the required annual payment. Okay? Self-employment tax. This is a tax that only self-employed individuals are paying. Who is self-employed? Somebody who is not an employee. They are conducting businesses themselves. And if they receive compensation or are generating earnings of at least $400, they must pay self-employment taxes. What is the rate? The rate is 15.3% of the first $176,100 of net self-employment income and 2.9% of net self-employment income in excess of $176,100. What is this? I mean, this is just double the FICA amounts, okay? And here, notice that you are only paying Social Security taxes and also Medicare taxes. I mean, here they are combined on this amount, $176,100. They are subject to both, but any excess is just subject to Medicare taxes, and the percentage that the applicable percentage or the applicable tax rate will be 2.9%. Self-employment taxes are allowed a deduction from net earnings from self-employment, and the deduction, you already know, is 15% of the self-employment rate. So, and that is an above-the-line deduction. Medicare taxes, this is a type of tax that applies to high-income individuals. So, we are going to apply additional taxes. One would be the additional 0.9 Medicare tax on wages received in excess of a specified threshold amount, and I'm going to show you that amount in a second, and also an additional 3.8% of tax on unearned income. Okay, so let's start with the additional Medicare tax. So we have an additional 0.9% Medicare tax that is imposed on wages received in excess of $250,000 for married taxpayers filing jointly, $125,000 for married taxpayers filing separately, and $200,000 for all other taxpayers, meaning single and head of household. Okay, so if you are getting wages in excess of this amount, then we are going to apply an additional 0.9% of Medicare tax to the excess. The additional tax on a joint return is based on the combined wages of the employee and the employee's spouse. Also applies to self-employed individuals that earnings from self-employment are used for the threshold computation. Okay, so this 0.9% Medicare tax is imposed to both employees and self-employed individuals. Additional tax on unearned income. Like I said, there are two taxes imposed to high-income individuals. One is the Medicare tax, the 0.9%, and the other is the additional 3.8% tax on unearned income. And that is what we're going to look at right now. So this tax is imposed on unearned income of individuals, estates, and trusts. Net investment income tax is 3.8% of the lesser of the net investment income or the excess of the modified adjusted gross income MAGI over these particular threshold amounts to 50, 125, 200,000, depending on the particular filing status of the taxpayer. So what is net investment income? A net investment income includes any passive income that you can think of: interest, dividends, annuities, royalties, rents, income from passive activities, and net gains from the sale of investment property. That's it. That's what your net investment income includes. So it is very easy to identify. Something that is not that easy to identify is MAGI. Why? Because MAGI has different definitions. MAGI generally is your adjusted gross income, adding back certain amounts that you have ignored previously, like exclusions. What are those exclusions? Tax-exempt interest, foreign earned income exclusion, non-taxable Social Security benefits, excluded adoption expenses, passive loss, or passive income adjustments. But the definition of MAGI is not the same for every type of tax credit that we are considering. The definition of MAGI with regards to the calculation of net investment income only considers the foreign earned income exclusion. So you are going to arrive to MAGI if you add back the foreign earned income exclusion. So you will take your adjusted gross income and you will add back your foreign earned income exclusion. That's what's going to give you your MAGI. And once you find those numbers, then you can apply the tax rate, 3.8% of the lesser of those amounts. What is your net investment income? What is the excess of MAGI over these thresholds? You compare those numbers and then you apply the tax rate, and that is your net investment income tax. I think we have arrived to the end. So, well, thank you for your attention and see you next time.